Eva, good morning. Give us your assessment of Friday. We mentioned that the stock market reacted in a much more dramatic way to what Jay Powell said than the bond market did, than the foreign exchange market did. Did it change the picture for you in terms of how stocks are positioned?
Not really. We think it was an overreaction. To us, the Fed revealed nothing new. They've been consistent with their messaging. I know many people thought they have been more hawkish, but we did not get into this mess overnight. So we should not expect to get out of it overnight either. It's going to take 1 to 2 years to see inflation reach the goal of 2%. That being said, we think we might see a reversal this week. The put volume was very low on Thursday. It then spiked. It doubled on Friday. And if you look at the advanced decline volume, the decline volume was much far ahead than the advanced volume. And last time that happened was on June 13 and June 16, which was then followed by a strong bull market. So we might see the same happen this time as well.
Yeah, I mean, there's no doubt that it was pretty aggressive selling and maybe on a short-term basis a little bit washed out. Although I guess longer term, if in fact you say it's 1 to 2 years perhaps to get inflation under control, Powell's saying that, we're going to have to deal with growth struggling under that scenario and rates staying higher for longer. Don't you think earnings are going to have to perhaps soften up a little bit? We still have aggressive growth expectations in the consensus for 2023.
Yes, definitely. But that being said, profits are still at record lows. We might see some cooling, but inflation affects each company differently. We are looking at margins. To us, margins is very important. Of course, we see retail, for example, struggling. Bed Bath & Beyond, Target, Wayfair, they're struggling with their SG&A, inventory is rising. But at the same time, you have other companies also in the technology area that are able to decrease their SG&A costs and expand their margins even with inflation.
Eva, question for you. Interest rates are going higher. Usually that's not great for long duration assets. You like technology, you like growth. Kind of try to explain that to us a little bit and go through your rationale.
Yes, definitely. So the narrative is since February 2021, growth has significantly underperformed the market. That was because of the expectation that inflation will go higher. Now we have the reverse. Now inflation has peaked, and hopefully we'll start seeing some cooling and inflation will start coming down. So we might see the reverse of what happened last year and earlier this year, with growth outperforming the markets and value underperforming.
Yeah, so it's the sort of earnings predictability of growth that is probably perhaps going to come more into the fore. Now, do you think that that we need to at least revisit the area of the June lows to sort of test it and see if it was the real thing?
No, I think we won't revisit the June lows, hopefully. I think the markets will be choppy for the rest of the year, but we might have a year-end rally. I think we need to be patient. I think the Fed will stay the course with a 75 basis points rate hike in September because there are two key things that they're monitoring: 3 consecutive months of lower inflation, and also the rate of change is very important. So if the rate of the decrease of inflation is accelerating, that's going to be a very good signal. So I think we might see some cooling in the rate hikes later in November and December, which will push the markets higher.
Shepard Smith here. Thanks for watching CNBC on YouTube.